Vic, are you with me, bud?
Right here. Can you see me?
Woohoo! No, but it's all good, friends. I have Vic Kirkarian on the line. Vic Kirkarian is like killing it with volume with United Wholesale Mortgage, which is the largest originator of mortgage-backed loans in the United States. I think Vic is like top 1%, Vic.
Top 1% of California loan originators. Yes, sir.
All right. Well, hey, thank you for joining us today, my friend. It's really a pleasure to have you. I'm going to just ask you what everybody is wanting to ask right now, especially if they're talking to a lender like yourself. There's a lot of talk about interest rates. Let's unwrap that. Where are we at today with interest rates?
Interest rates are right around 3%. On the new conforming loan amount has been raised to 625, which is the biggest increase in the history of conforming loan increases. And on conforming loans, most of those are still under 3%. In San Luis County, they raised the high balance to 805, which are the interest rates that are right around hovering around 3%.
So we're at about 3%, and we've had the largest home surge with home price appreciation in history. So the FHFA has raised that conforming loan limit almost 18%.
Yep, and that's exactly what caused the increase was the increase in home prices. Is they use the median home price per county to dictate what the conforming limit's going to be in each county.
Yeah, and what's been happening with rates with this with Omicron? We got to bring up the pandemic.
The last 6 months have been up and down, but give or take, you're talking between 3 and 3.3%. Currently, we're towards the bottom of that, as the bond market has been dropping the last couple of weeks because of this new scare and this new variant of this.
Right. Yeah. No doubt. No doubt. I mean, the world could change overnight. We've seen that before. So when you're talking the bond market for a lot of our listeners that aren't in mortgage and real estate every day, you're talking about the 10-year.
The 10-year treasury bond is what dictates the 30-year mortgage rates.
Right. And I've been talking with, yeah, thank you, Vic. I've been telling, and sharing with my listeners that the interest rates are loosely tied with the 10-year. It's not the federal government that sets interest rates.
Yeah, the Federal Reserve rate, when they raise that or higher, lower, taper, or whatever, those are more for your short-term rates, for your credit cards, car loans, lines of credit for your houses.
Okay.
And that kind of stuff. The long-term rates are all based on the 10-year treasury bonds, which are your 10-year, 15-year, 20-year, 25, 30-year fixed loan products that you get from mortgage broker or mortgage lender.
Right. So interest rates loosely move with the 10-year. So for our listeners, let's talk about the 10-year. What causes the 10-year to go up and down?
Well, it's supply and demand, pretty much just like anything else. So if, for example, when it dropped, when COVID had first started and we had all the shutdowns and the first stimulus package that passed had an unlimited amount of federal aid going, or I don't know if you call it federal aid, but basically federal money going to the bond market to buy unlimited amounts of bonds per month, which caused the mortgage rates to drop under 3%. And currently, the scare of this new variant has investors putting their money into the bond market because they're afraid of what's going to happen in the stock market. They'd rather get a safe return, a smaller safe return than a riskier bet on a stock that could drop 50% or whatever. That you never know. But and it's basically a safer bet when there's a lot of uncharted territory ahead.
That makes a lot of sense. So when investors, when investor sentiment is a little skittish, bond market is going to basically the 10-year will probably drop.
Exactly.
Yeah.
And that's kind of where we're at. And for the last 6 months, we're closer to the lows for the trend that we've seen the last 6 months, which is probably bottomed out around 1.35, and we're at 1.43 today. So we're closer to the bottom, and I'd say it topped out probably around 1.7.
Yeah.
So between 1.35, 1.7, we're at 1.43. We're right there closer to the bottom than the top of the current market rate wise.
Well, it's crazy to think that there are still people out there that have a 4% interest rate or a 4 in front of it.
That's just
So they
because they
should
haven't
call you
called
right
us.
away.
That's what I'm saying. They just haven't called us yet.
Yeah. So it's still, so I mean, if you're talking to a buyer right now that's thinking about, waiting, I mean, what do you think? What are experts? What do you see with interest rates in the future? Q3, Q4, this time next year.
Well, I mean, like I said, anybody that's going to give a guaranteed prediction has no idea what they're talking about. But what
That's
the
true.
analysts,
Today,
what the
especially.
analysts are predicting, which I like personally to listen to, which I think you do also, is Fannie Mae, Freddie Mac, because they
Yeah.
have a lead in the game. So their analysts are typically very well rounded and very well educated and are pretty dead on a lot of times.
Yeah.
They're saying that it should be somewhere between 3.6 and 4% by quarter 3, quarter 4 by 2022. So within a year from now.
Well, there you have it. So if we remain, with low rates, and historically, and I mean, you've been in the business at least 20 years now, even when rates were 6%, were you having a hard time, getting people to or to actually apply for a loan? Were there any lack of loan applications when we were in that environment?
No.
No. So that's the same thing. Historically, rates don't necessarily impact real estate sales.
No, there's always going to be. Back then, they did have interest only, blah, blah, blah products, which are now regulated, which you can't have on a primary residence, this and that. But there are a lot of loans coming back for investment properties that are interest only, which would give a buyer more purchasing power, right?
Yeah.
Back in those days, we did have a lot of those interest only negative amortization loans, which would help a borrower get into those houses. Now what we have now over then though is we have higher incomes. People's incomes are actually a lot higher than they were 15 years ago when we had those higher interest rates. So, and the interest rates are lower. So basically it's a healthier market.
Interest rates are, you can write your interest off on your income tax.
Exactly.
So
More so on an investment property, also an investment property on as far as income tax, I believe. I mean, you have to talk to an accountant, but I would assume that would be looked at as an individual business.
yeah. So let's stay in our lane. Back to real estate and mortgage. Hey, so everybody wants to know, what do we see happening in the real estate market next year? We're going to have, it sounds like rates below 4%, inventory, they can't build them fast enough. I don't see, we're still below 2 months of inventory in most markets. All 50 states in the United States appreciated. So I think we're going to have a watered down version next year. What do you think?
I think that's a perfect way to word it. I think we're still going to have demand. We might not be getting 50 offers per house, but we're going to be getting, we'll still be getting, I believe, multiple offers on really good listings, and we're going to have a healthy mortgage market and a healthy real estate market to go with it.
How about now? Since real estate is so seasonal, historically there's a slowdown in the winter. We know this has been anything but a normal market. Are you seeing any slowdown?
No, actually this week we've got more applications than we have in the last few weeks, but to be honest with you, I haven't really seen that trend in years. I mean, we've had just as busy Decembers as we've had Mays or Junes, and typically at that, when we first started 20 years ago, you're right, May and June would take off after people were done filing tax returns or getting tax refunds or whatever.
Nobody wanted to do anything.
I see a consistent pipeline that's consistently full.
Well, Vic, I know you're a busy guy. If my friends want to get a hold of you, it's California Mortgage Solutions, vic.loans at, what is it, Gmail?
That's my personal, vic.loans@gmail.com.
All right, my friend, there's a lot of people that could use your wisdom and your insight. And again, working with United Wholesale Mortgage, you have insight. You're in meetings every week. So I really find your insight valuable. And thank you. I really appreciate it.
You have a good afternoon.
Thank you, Vic.
Have a great day.